Dan, you mentioned it when these companies reported, where it was Walmart and also Target, that they got shit from people on CNBC because they said, listen, we're not going to pass off all our costs to consumers, because if we do, we're going to lose a consumer. So they're going to eat some of those costs. And, that was a negative reaction. But I love that, because long term, that's a fantastic strategy. Because if these companies think that they can continue to raise prices, and especially restaurants with labor shortages, and have worse service and removing stuff from their menu, and you're still going to expect people to come there as you raise prices, you're crazy. And that's where we're at right now. And I think you're seeing that in some of these results. But the Dollar Trees, McDonald's, Walmarts, these are places that people are going to start going to a lot more, because they're affordable. It makes sense. And even though they're raising prices, they're not raising by as much as everyone else, where everything's still affordable at these places.
Absolutely. We were joking about this. And again, we are in the newsletter business. We want to entertain. We want to educate and help the individual investor. It's just frustrating, because we were talking in the office, and I said, man, I'm finally bullish on Target and Walmart. We got out of Walmart. We bought the same time in Curzio Research Advisory. We still have Target. It's a great winner. It's a great boring stock. But when you see the stocks pull back for what the CEO of both Target and Walmart said, and, they pulled back, 3-5% maybe. We're not being drastic here. We're not putting out headlines and saying the stock's tanking when it's down 3% like a lot of people do. As an investor, when you have the heads of these companies saying, hey, we're not going to gouge people, we're going to help them. We're still going to manage the bottom line. We're still going to focus on profits and rewarding shareholders, but we're going to invest in the things going forward, because you're a grocery store business. You're a services business. Of course, you want long-term customers coming back, and that's how you keep customers and you gain more customers. This is an easy segue, Frank, to who got reappointed the other day? Fed chair. Mm-hmm. So the low-hanging fruit here is nothing is going to change as far as the direction of things that are going. And what direction do I mean? I mean, the rich are getting richer, poor are getting poorer. Inflation hurts those at the bottom the most when food prices and things go up. So think if you had 15 to 20% of your wages going towards food, energy, and living, as that continues to increase for the bottom half, there has to be choices being made when people's lives start to get affected. So Dollar Tree, Frank, did you see this stock? It's up over 50% from basically mid-September. Dollar Tree is.
No.
It went from 80 and change to damn near 140.
Wow.
86 to 138. Right now it's up 4%. Mm-hmm. Dollar Tree is great. Those are really solid areas, but I'm with you on Walmart and Target, and also Amazon. And it's not investing in the right things, your people, logistics for the longer term. It's not a big coincidence that Goldman Sachs, the most wonderful, awful people in the world, picked Amazon as their stock of the year next year.
Oh, did they really? Yeah. I mean, I think Amazon's
maybe one of them. I don't want to exaggerate like crazy, but I believe it's their top pick for 2022.
Oh, yeah.
And it's Amazon.
Yeah.
The smartest guys, listen to this. The smartest guys on Wall Street are telling everybody to buy Amazon.
Yeah. And nobody
just
cares.
like us, nobody's going to listen.
Nobody wants to buy Amazon. They don't, especially young investors. You tell them to buy Amazon, they'll tell you, shut up, I'll never listen to you again. Yeah. Right? They don't care if it goes up. They rather, give me a story stock ESG, give me another, a crazy name. And that's really what they like, which is funny. But, I look at Amazon too, guys, it's not just looking at an earnings report by itself. You have to look at what the stock has done. And, I pulled up a chart showing how Best Buy is, not that far ahead year to date of the S&P 500, yet you've seen a pullback of 15%. But with that said, since October 1st, this stock is up 35% going into this quarter. 35% nice. Wow. Best Buy is up going into this quarter. So now you've seen a pullback and people taking profits. So, again, you have to look at where these stocks were and where they're going. And is a lot of that priced in, right? It's not just like, wow, this company blew out the earnings. How come it's down so much? Well, if it's up 150% year to date or 35% leading into the quarter, I mean, it's almost you can report anything there and the stock's going to take a little bit of hit. It's going to be a little bit of selling news, which is common. But the more important theme here, I think, overall, when we're looking at earnings and stocks, it's a dangerous environment. There's a lot of stocks that are down 20% plus. And the Russell 2000 has really gotten hit. You're not seeing it by just looking at the major indices of where they're trading or even the Russell 2000, but the underlying trends and the stocks hitting new 52-week lows. You're seeing the VIX rise above 20. I can't tell you how many stocks I've seen get hit. Snowflake got nailed right out of nowhere. after making a nice move. Just so many names that I was like, holy shit, I can't believe how much these are down. Technology names. I don't know if it's Powell and, people believe we're going to see more inflation under Powell, which means if we're going to see higher inflation, it's not as good for technology companies. And people say, well, that's crazy. Why? Why is because they can't really cut. Their margins are already incredibly high. So they don't have the benefit of cutting costs like cyclicals do. Also, when you see lower CapEx spending, that's where these guys make their money, right? CapEx has to do with spending with companies. If it has to do with marketing, you're going to cut your marketing budget, right? If your sales go down, usually your marketing is a percentage of sales. So marketing is going to come down. That's lowering, your CapEx. Lower CapEx, that's less money you're going to spend in marketing when it comes to on Facebook platform, or if you're going to spend on Google. So a lot of these technology companies get hit, and I feel like people don't understand that, but they're going to get hit more in an inflationary environment because they can't really do anything other than raise prices, but they can't really cut costs as much to get those margins higher, and that's why they get hit. But overall, these trends are pretty crazy right now when you're seeing what's going on with some of these stocks. I've seen a lot get hit, and I just feel like it's misleading because people are probably looking at their portfolios and saying, holy shit, I'm down. But why is the S&P 500 near an all-time high? It's because a lot of the underlying stocks are really, getting nailed. The money's just flowing out of them like nothing on no news, right, Daniel? I mean, earnings season's over. A lot of these companies reported, and you're seeing, holy shit, why is this stock down 15% and nothing's going on? I can't tell you how many emails I get, just, hey, Frank, I own this stock or I own that stock, and why is it down 50? Not even in our portfolio or whatever, but just, I can't tell you how many times I'm seeing that. And it's basically over the past 2 weeks. Yeah,
there's a lot of volatility, and that's going to continue because you can't have excess liquidity without things moving around large percentages. So, and to agree with you on the tech, it has to be, markets are forward looking. So, hey, what about interest rates? They have to go up at some point. You've been saying that, but, one day doesn't make a trend. With the reversal in the NASDAQ yesterday or earlier this week, everybody knows that, basically Powell is saying he's going to try and give you every little bit of information to have a soft landing when it comes to inflation and higher prices and things. So maybe the market tries to test him a little bit. We'll see what happens there. But for the high-flying tech, it's interesting to me that Square, PayPal, the payment services are down a lot.
Cloud is down a lot.
I would definitely look at that. I think it's a little early right now, but there's nothing wrong with hiding out in big tech. I mean, you can't buy enough Microsoft, in my opinion. I think that's damn near a 52-week high if it's not. I've been a big fan of Meta for a while. That's not, that kind of tech, but Google and Apple's at an all-time high. So hide out in the big dogs if you want to play in the space, and you should have exposure to that. There's nothing wrong with that. Those are great companies. So
yeah, that's the safe havens. But you're looking at Rivian down a lot too. Again, when I look at Rivian, and I was doing some research on this, Daniel, and I'm going to spend just a couple minutes on this because I really want to get to very important news about the strategic oil reserves. But when I look at Rivian and do what we set it to 1 million in sales, and it has, $100 billion valuation. This thing came out of the gate at, 100, went to whatever it was, 175. I don't know. I think it's like 115 today. I think it's short-sighted the way some people look at these. And I could be blamed for this as well. I could be blamed for this, though, because when I look at some of these names, when I looked at them in the past, I say, you're crazy to buy. When we go back and we look at what people said in Netflix, like 2002, 3, 4, 5, 6, what people said with Tesla over the last, 6, 7 years, Chanos, David Einhorn, biggest fraud, all this stuff, going after these guys. I see it all the time with some of these growth companies, and I just think it's misleading because when you look at Rivian, people say when compared to Ford and GM, that's a joke. They're not even producing yet. Okay, I get it. But I want to try to figure out what I got wrong on Netflix, right? And what I got wrong on Tesla. And what I got wrong is I didn't understand the TAM, the total addressable market. When you look at Netflix back then, how many people hate it and said, it's terrible, it's going to get crushed. Even, Netflix, Tesla, all of them. You don't realize when it comes to Netflix that, they were looking at it saying, how could they be as big? They're streaming. How could they be as big as some of the leading cable companies or direct TVs or whatever back then? But now you're looking at everyone in the world going into streaming, trying to catch up. Nobody really gets it outside of Netflix. I mean, they don't. Time Warner's starting to understand that it's about new content and it's about binging. People don't want to just go streaming where they can only watch one thing. They love to binge. They love when that stuff comes out and they can watch all this stuff. Then you look at Tesla and you say, wow, look at this valuation. It's crazy. How can it be bigger than GM? How can it be bigger than Ford? That much bigger and bigger than all the companies together combined as a market cap. Well, you notice how the entire world is trying to play catch up to them, right? Because they have their EV. You see Teslas on the road all the time. Do you see any electric vehicles on the? No. Every one of the. So now they captured a market that the whole world is trying to get into. And if you look at the valuation or look at companies this way, maybe you'd invest in something like this or a Rivian even at these levels, because Rivian right now, supposedly from the people I talk to, smart people in the industry, they have the best technology batteries. The Rivian truck is absolutely amazing. If you see it, look at videos, it blows out the Ford 150 Lightning. And I have to tell you, when it comes to Ford, Daniel, Ford controlled that market. The largest selling vehicle, the biggest selling vehicle. Now they're only going to be, when it comes to the electric vehicle, producing 10% compared to, the production that it produced when these things are, gas vehicles, right? So, and they don't really have the technology for batteries yet. That's why they're spending $30 billion for it. Again, it's exciting and it's 20. I get it's going higher. But, when I look at Ford and I look at Rivian, Rivian's truck is a million times better. And now Ford just went from a market that dominates, which is the pickup truck, to now an EV truck, which you're not going to dominate anymore because there's better players in this industry that are going to be selling more trucks than you in this industry, right? So it's something to think about with Rivian, where, it's crazy, 1 million, but the orders are actually, they're piling up like crazy. You have to put $1,000 down for this. I actually looked through this. I put $1,000 down and bought a Rivian. Did I tell you that? I did that yesterday.
No.
You could say you bought it. I put $1,000 just to go through. It's fully refundable.
They're refundable?
Okay. Process. But I can imagine how many people going through the process when you see this truck. This truck is absolutely amazing. If you go on YouTube and watch the Rivian R1, it's really incredible.
I'm gonna be rude and interrupt. When you say you see this truck, it's all online though. You didn't go anywhere and look.
No, but I am going to see the Consumer Electronics Show, and hopefully I get the chance to drive it. If I do, I'm going to put it all over YouTube and everything and tell you guys, give you an update. But you see, this truck, which is unbelievable, start shipping in January. It's going to ship before the F-150. And they have the best technology in the space. So it's going to be interesting to see how this plays out. But, just a different way to value companies where, again, right away we're quick to judge and say, holy shit, look at these sales. Yes, it has a massive market to grow into, but the whole entire world is going into EVs, just like the whole entire world is going to streaming. And if you're the number one player in that market, that total addressable market is freaking enormous. Right. So it's just something to think about when it comes to valuation. But I did want to bring that up because I get a lot of questions on Rivian and even Netflix these days, and look at NVIDIA as well. Valuation is insane. Why? Because they're the nuts and bolts. They produce the parts for the highest growth industries in the world, whether it's AI, whether it's autonomous vehicles, whether it's EVs, computing, just everything that super fast chips, the best in the world. And these guys are in it, and that's why they deserve that premium. Anyway, I don't want to go that far into it, but valuations are kind of a stretch here, but it might not be a stretch for some of these other companies that people think are absolutely crazy to purchase.
Right. They do. It is difficult. And I'll be honest, I've missed a lot of those, these high growth ones, because you don't want to be focused on just fundamentals, because nothing would ever really, it'd be very difficult to grow anything if you didn't take chances and do things like that. It's just, we were joking earlier, it's not a price to earnings ratio anymore. It's price to expectations. So will these guys be able to execute? NVIDIA is executing. Not to put words in your mouth there, but Rivian, if they start delivering trucks in January like they're supposed to, they have huge backlog orders. Amazon alone, and you have a tight stockholders. Amazon owns 20%. We talked about that a while ago. Ford owns, I think, 14% off the top of my head. Those, more than likely, those shares aren't going anywhere. You have a smaller float that can help control the price. It's just an execution story. As an investor, if you want to play in that game and play those high growth ones, great. Just know they're going to be volatile. If not, it's not going to ruin your retirement if you miss out on one or anything like that. So.